How's it going, friends and family? My name is Amos, and I'm a hybrid investor that applies multiple schools of thought into my approach to investing in stocks. I know that sounded way too fancy. In other words, I cherry pick the best practices and implement it in my portfolio. Dividend investing, contrarian investing, such as buying the dip, growth stocks, I like it all. However, one thing that I have witnessed is the hate for dividends has gone way too far. The hatred, it's like a bandwagon, especially from the Boglehead community. Having said that, let's go ahead and see what Jack Bogle has to say about dividends.
And I think we should spend more time thinking about dividends rather than market values, because market values are all over the place, and dividends are pretty reliable to go up a little bit each year, like inflation is. I think dividends are fairly secure, and you should be worried not about the value of your estate, but about the income-producing capacity of the state of your estate or your retirement plan, because that's where you go out. Once a month you go out to the mailbox and get your mutual fund dividends and your Social Security check, and then you come home and have a nice dinner, live in a nice house, whatever else you want to do. So we should focus. I really believe this so strongly. We should focus more on the inherent value of our investment program than on the market value, because markets are crazy things, and that's what makes investing so difficult. And if you want to look at it that way, so much fun.
But what people should be doing, honestly, Tom, is stop looking at the silly stock market every day and look at the cash flow they get. For stocks, you probably want to look at more of a dividend bias. You could buy a high-yield dividend index instead of the total stock market index if capital flows. And that dividend, if you look at the stream of dividends, it makes the stock market look violently volatile. The dividend stream goes up, up, up. And the fact of the matter is there have only been two significant dividend cuts since 1925. One was in 29-32, and the other was a few years ago, 2007, 2009. All of these things are clear in the past, and in a lot of ways that doesn't matter. But if you assume that American business grows, that America grows, that the dividend stream will keep going up, and as people ask all the time, corporations sitting on huge amounts of cash, so dividends should not be jeopardized, absent some real problem in the world and the economy.
Stocks that compound and dividends, please. Welcome to investing with a side of cheese, where balance sheets matter and cash flows get fatter. But hey, I'm not a financial advisor. Now here's the thing. I went down the rabbit hole of old interviews with Jack Bogle, especially in the last couple decades of his life, and it's consistent. You'll see he was obsessed with dividends and cash flow. To the godfather of index investing, which makes sense for 95% of investors out here, just put your money into SCHD, VOO, SPY, VTI, whatever, call it a day. Dollar cost average every week, 2 weeks, whatever cadence. That makes sense for most people. But I digress. To the godfather of indexing, dividends were the ultimate anchor of long-term wealth creation. And believe it or not, in his final years, he was actually really against stock buybacks. He constantly fired shots at S&P 500 CEOs for using cash to artificially pump their own stock by doing share buybacks, instead of paying out direct, honest dividend checks to the long-term owners. So in this video, we're going to talk about why the anti-dividend crowd, y'all got it wrong. And just a quick heads up, you'll see behind me the background is empty. And that's because I practically have 1 foot out the door. But if you know anything about me, I have the work ethic of a lunatic. So I wanted to cram one more film session before the big move back to the United States. All right, so let's start off with number one. You've probably heard the popular anti-dividend argument. Dividends are just forced sales. And the whole premise is this: the company is forcing a taxable event on you, and they're shrinking their own balance sheet while doing it. However, let's flip that logic and think about it like this. The real truth is that retained earnings are forced investments. In case you didn't know, Accounting 101, dividends are accounted for from the retained earnings on the shareholders' equity on the balance sheet. Shareholders' equity plus the liabilities equals the assets. I have a balance sheet 101 video if you want to get caught up or if you want to get up to speed. So dividends force management to be more disciplined with their capital. When a company commits to a dividend that's scheduled far in advance and they have like 20 or 30 years of paying it out plus growing it, they can't just waste excess cash on vanity projects, overpriced acquisitions, or bloated R&D that may never provide a return. Because think about it, if a company has a 50 or a 60% dividend payout ratio, meaning they utilize 50 to 60% of the bottom line to fund the dividend, that means the other 40 or 50%, the company in question has to be more selective and efficient with whatever cash they have remaining. And the thing is, retained earnings are often poorly managed by CEOs who suffer from growth at all cost logic, mentality, perspective, and they tend to throw Hail Marys at the craziest projects to keep the growth engine going. These companies will burn through cash in order to stay relevant and keep the speculation, hype, and narrative surrounding their company to be bullish. And if we're going to be frank, that's kind of a disservice to you as a share owner to see the cash just being thrown away. Why not return some of it back to you, right? And then here's point number 2 that the anti-dividend crowd likes to make. I only care that the profits grow every year. I don't care about the dividends. Okay, pump the brakes and think about it like this. Through financial engineering and accounting manipulation, their one-time tax events, or writing something down, a publicly traded company can report profits for years on end on paper, also known as their bottom line, their EPS, their earnings. And that's why, as a proxy for the profits on an accounting basis, I prefer on the cash flow statement, the free cash flow, because you can't manipulate that. You truly see how much cash is going into the pockets from the operations, but that's for a different topic for another day. But a consistent growing cash dividend, it cannot be faked or manipulated. You either have the cash flow to afford it quarter after quarter, month after month, or you don't. So the dividend to me is a more reliable indicator of a company's actual financial health rather than the EPS that can be easily manipulated. In fact, if dividends are useless and unnecessary, then why do most of the blue chip companies, why do they end up initiating them? When we think about Meta, right? They started paying a dividend in February 2024. Why not just continue reinvesting all the cash back into the business for being a growth Cinderella unicorn business operation? Or their cousin from West Virginia, Google, they also initiated a dividend in June of 2024, and also another one that just started paying a dividend, Booking, 2024. Likewise, I'll round it out by another growth company that was like, hey, we need to start paying a dividend. Salesforce, also Q1 of 2024. That's because these companies understand the assignment that people buy into your stock, not just for the share price appreciation, but also for the dividends that they reward back to the share owners. And also it opens up the door to being included into several ETFs or to an index that is exclusive to only dividend paying companies. But more importantly, Meta, Google, Booking, Salesforce, these are not terrible companies led by terrible leadership. They're smart, they're intelligent, and they're using their capital wisely. And they initiate that dividend because they are consistently profitable to the point where they can forecast and calculate their dividends. You can't do that unless you know the amount of cash that you're generating, the profits, is stable. You see, that's something you have to realize about me. I don't just look at Salesforce as a ticker, CRM, customer relationship management platform. No, I look at it as buying a business. So if I invest in Salesforce, I am an owner of that business. And an objective of being an owner of a business is to get paid. That's exactly why if you buy a real estate portfolio, physical cash producing assets like an apartment complex or a commercial building, a laundromat, or whatever in question, you buy that real estate because of the cash flow it can provide you. And the last sentence that I'll say to the folks that are growth at all costs mentality, net worth, it fuels your ego, your portfolio size. However, cash flow pays the bills. Having a big portfolio is nice and all, but what's the passive income generated by said portfolio? That's more important to me because I don't want to reduce my ownership of cash producing assets. I would much rather sit back and collect the paychecks from the assets in my portfolio. And then another very popular speaking point by the anti-dividend crowd is all that matters to me is the CAGR, the compound annual growth rate. When you take the share price appreciation of that stock plus the dividends and you bake it together, what's their growth year over year? That's all they care about. To a certain extent, I agree. The performance and total return, that's what's important if you're in that wealth accumulation phase of your life and you're trying to grow your net worth, your nest egg as big as possible. But believe it or not, a big part of that equation, that performance, it's the dividend. Case in point, let me show you a tangible example using 3 business operations across 3 different industries. Number 1 is going to be Old Republic International Corporation. For simplicity's sakes, it's an insurance business. And then we'll also toss in One Main Financial, which is a consumer lending operation. And then, of course, Hess Midstream, which is a midstream pipe oil mover. They don't care how much oil goes through. As long as there's a drop of oil moving through their pipes, they get paid. You take a look at all of these companies and their performance in the stock market, it is a pretty compelling case and it's beautiful. Right? If we scroll down and take a look at their CAGR in the past 10 years, the CAGR for One Main Financial is 14.6%, 14.8% for Old Republic, and then for Hess Midstream, it's pretty new because they were a spinoff. In the past 5 years, their CAGR is 17%, and then for the past 6 to 7 months, their performance has been booty hole because of the pending interest rate cuts and inflation being sticky, and for the financial lending business, but also insurance, your business thrives when the interest rates are high, but knowing that the interest rate cuts are coming soon, it's like, you know what I'm saying? So investors are preemptively selling out of them and pricing in the cuts and rotating it into the semiconductor chip stocks, the AI bubble related names as well. In case you didn't know, rotations in the stock market happen all the time. So why am I calling these 3 names out specifically? Because if you take a look at them, it's not the share price appreciation that's impressive. Like Old Republic, for the past 5 years, share price appreciation alone, 39%. But once you bake in the dividends, then it turns into something that's delicious with a capital D. Dividend yield, 10%, growing their dividend for the past 46 years. Growth rate of their dividend, 19%. Likewise, why did I specifically call out Hess Midstream? They've been publicly traded since about 2017, 48% in the green with only their share price appreciation. But once you bake in their fantastic dividend profile, 8% dividend yield, that's why their CAGR was beautiful. And then once again, with One Main Financial, if we hop on over to their stock price chart, take a look at the past 5 years, negative for all case and purposes, negative 5.3% in the red by just their share price appreciation, or I guess in this case, depreciation. But because of their fat, juicy dividend profile, 7.6% dividend yield, they still end up being a pretty beautiful compounder. And that's why when people say CAGR is all that matters, the compound annual growth rate, they're looking at a spreadsheet and not real life. They completely forget the human element of personal finance, but the psychology of managing your emotions. At the end of the day, your personal goals and your actual risk tolerance matter way more than some historical growth rate that may or may not pan out the same way that it did in the past in the future, because I truly believe that past performance is not indicative of future gains or growth. But dividends, on the other hand, it's not speculation. Matter of fact, even during the pandemic, when business operations were forced to close their doors because we couldn't go out in public, only 15% of companies cut or froze or got rid of their dividend. 85% of business operations maintained or grew their dividend despite that. So dividend cuts, they don't happen as frequently as people like to tout. And on any given year, on average, I think less than 1 or 2% of companies cut their dividends. But the fact of the matter is, when we think about Coca-Cola, Meta, Microsoft, Realty Income Corporation, or one of these three names, Hess Midstream, One Main Holdings, or Old Republic, they're not going to be cutting their dividend anytime soon. These are high-quality dividend compounders with cheese. And the reality is, a lot of investors out here, they value certainty over chasing the maximum possible upside. Yes, they know full well that by just investing into this or this growth vehicle, you'd get XYZ. To that, I'd say there's absolutely nothing wrong with trading a little bit of total return for a steady, reliable stream of income in the form of dividends or distributions, high return of capital, ROC. Shout out to Neos, but the Goldman Sachs GPIC and GPICs. And that's because for a lot of those folks, they would prefer to use that passive dividend income to cover their daily expenses or to fund their lifestyle in retirement. If you just pause this video and take a look at the comments section, there are a handful of people that are retired off of dividend income and they're living their best life. I mean, just take a look at the community poll posted a couple months ago. It's a reality. It's something that people are doing. When you do dividend investing, it gives you a massive peace of mind and it covers your real world bills. A high CAGR looks great on paper, and it probably makes the most sense in your 20s and 30s, maybe up to your upper 40s, but it's completely useless if the wild ride it takes to get there keeps you up at night, or if it doesn't give you the cash flow that you actually need right now. And then let's address this one. Usually, this is how I know we're not dealing with logic and facts, but rather, when an anti-dividend individual has their back up against the wall, they'll say something similar to this. Dividends are never the reason a stock has good performance in the stock market. It's because of the stock's numbers and financials. In other words, it's because of the quality of the underlying business that they thrive. And to that, I say this. Did you know that there are stocks whose sole purpose is the dividend, including REITs, the real estate investment trusts? Because back in the day, only wealthy individuals could buy commercial real estate and pocket the passive income that they generated from their physical assets. But through REITs, now anybody can invest in real estate, but also business development companies, aka BDCs, midstream oil and gas, and others, where their whole purpose as a stock is the dividend. And their CAGR is really, really fantastic because of said dividend. Take REITs, for example. By law, REITs have to distribute at least 90% of their earnings out to shareholders. And in return, they get a special tax treatment. So the REIT's structure is literally designed around turning cash flow into dividends. And in these business models, the dividend is the primary mechanism through which shareholders participate in the company's profits. And if you take a look at your screen right now, historically, the REITs have outperformed the S&P 500, aka the market, for 50 years, represented by the blue bar, the S&P 500, the green bar. Prior to the year 2022, the REITs definitely the better ROI and growth. And remember, REITs, the primary mechanism is that dividend. That's why people invest in them, not for the share price appreciation. And if we scroll down this article by the Motley Fool, REITs versus stocks, everything you need to know, posted, or I guess updated April 2026. Dividends account for about half of all REIT returns. They go on to say, since 1940, 34% of the S&P 500's total return has come from dividends, according to Morningstar and benchmarks by Hartford Funds. And the article goes on to say they found that the S&P 500 companies that paid a dividend outperformed the growth non-dividend paying stocks by a wide, significant margin from 1973 all the way to the end of 2024. The dividend paying stocks, their CAGR was 9.2% versus the growth stocks with no dividend, 4.3%. So, a company returning capital to shareholders absolutely affects the shareholder returns. And that, friends and family, is mathematically undeniable objective truth. When it comes to REITs, the dividends are the main bread and butter for their performance in the stock market. I just want to talk about one of my passive income holdings, Realty Income Corporation, my most favorite REIT stock. Ticker symbol O. Realty Income Corporation does commercial real estate, meaning they rent out their buildings to companies like Walgreens, Walmart, Target, car washes, and the list goes on and on. If you take a look at their share price appreciation without baking in the dividends, it's 644%. Without the dividends baked in. This is pretty good, right? But watch what happens once we introduce their dividends. 5% dividend yield paid out on a monthly cadence. You ready for this? Check it out. Maximum timeline with the dividends baked in, that's 644%, would now be 5,200%. Talk to me about how dividends do not matter at all. For Realty Income Corporation, the dividends, that's what allows them to be a beautiful dividend compounder with cheese, and their CAGR for the entirety of their stock market history is a 13.3%, which is pretty darn good. High REITs, high dividend paying stocks, you guys are quite fancy and beautiful. Come on over, enjoy my portfolio, and pay me rent, please. That's why Realty Income Corporation is one of my core positions in my passive income portfolio, which I promise one day I'll start a new series centered around that portfolio. As of right now, it's all about the dividend compounders with cheese portfolio, which is about growth and CAGR. But I also really like dividend investing, if you can't tell. Please do keep in mind that dividends aren't random or a burden to shareholders. Dividends happen because a company has a mature business model and the kind of durable cash flow that leaves them with excess capital. When a business doesn't need to constantly reinvest every penny back into the operations, aka a shareholder-friendly management team, they'll usually do the right thing and they'll hand that cash back to you because you are a part owner of that operation. And I don't like the idea of selling my assets to produce a synthetic dividend. Why not just sit back and allow my assets in my portfolio to remain the same? If I have 100 shares of Microsoft, I can still have 100 shares of Microsoft. Why would I eliminate and punish Microsoft and reduce my holdings from 100 down to 70, down to 50? Why get rid of my real estate asset? You see what I'm trying to say? So that's why I like dividend growth investing. And this is part 20 in a 100 episode series of me defending dividend investing. Hopefully you got a thing or two out of it. Let me know your thoughts and opinions. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you really soon.